Chapter 3. The Hunters, Pursuing Losing Shares. In this chapter we meet the hunters. Like the assassins, the main reason for their success was what they did when they found themselves in losing situations. Unlike the assassins, they did not sell out of those positions, they bought significantly more shares. Rather than killing an underperforming investment and forgetting about it, they stalked their prey, watching it get steadily weaker and lassoing another limb every time it stumbled. Then they sat back with their prize and waited for it to recover, eventually selling it on for a handsome profit. In gambling, such behavior, effectively doubling down, is known as the martingale approach. It is frowned upon, and rightly so. It often leads to ruin. But in well-chosen investments, this is a strategy that wins over time. You acquire more and more assets at cheaper and cheaper prices. When the price of the assets goes up above the average price you have spent, even if it is hardly motoring into new highs, you will be making money. Let me stress at the outset that the hunters, like all successful practitioners of what is called dollar cost averaging, planned beforehand to buy more shares if a price fell. So they did not go all in on day one. Rather, they invested a lesser amount at the outset and kept some cash on the side, waiting for an opportunity to buy more at a lower price in the future. The key reason for the hunters' approach lay in their invariably contrarian style. They were value investors. They generally found themselves buying when everyone else was selling, and this was an extension of that philosophy, another way of exploiting Mr. Market when he was acting irrationally. The approach the hunters took is a little like the one many of us adopt when it comes to bargains in the January sales, putting off purchases beforehand because we believe what we're after will end up getting sold at a significant discount. Unlike in a January sale, you don't have to queue up outside for hours and fight your way through fellow bargain hunters. You can slowly acquire more and more of your purchase as its price gets slashed. Success starts from failure. There is a surprising overlap in early investing experiences among the hunters. Near the start of a significant number of their careers, the hunters had the good fortune of having a terrible year. It was a year in which they lost many of their investors a lot of money, and soon found themselves losing a lot of their investors. By the end of one early traumatic period, one hunter I worked with told me he only had a single client left. The reason this turned out to be fortunate was because of the lessons the hunters learned. They are what ultimately led to them delivering returns that made both them and their clients very wealthy indeed. The hunters realized that being a contrarian investor is dangerous because you are always going against the crowd. As such, they became experts on interpreting charts and other methods to truly gauge the crowd's sentiment. After all, it was no use buying when the crowd showed no signs of changing its mind anytime soon. It burned into their minds the important fact that just because something is cheap does not mean you should buy it. They also grew unafraid to sell if it became clear they really had made a mistake. Poor value investors I have come across refuse to adapt when they are losing and tend to support their lack of action by saying, "I got it wrong. But the stock is simply too cheap to sell now." A bad contrarian investor can make for a very committed rabbit. But if a stock still passed the vital "would I buy this knowing what I know now" test, the hunters followed their plan and started to put their money on the side to work as the share price dropped, snatching victory. Some of the hunters working for me did not simply buy more of a stock if it fell beyond a certain trigger point, say 20%. Rather, they enjoyed trying to pick the bottom, buying in at the greatest possible discount, something that is very hard, if not impossible, to do. I saw a number of the hunters get too many of these calls right to think they were playing a losing game. That said, the rest of us are probably better off. doing what the others did and simply buying significantly more shares. When a stock price falls between 20% and 33%, the reasons for this were covered in the previous chapter. That was the range in which the data made it clear it was sensible to materially adapt. The exception is if our conviction in a stock has lessened for a good reason. In that case, we should do exactly as the hunters also did, and sell. I saw the hunters double or treble their holdings at the bottom on several occasions and then enjoy the rewards as the shares recovered. It was clear that such moments gave the hunters a real adrenaline kick. Apparently there is no better feeling than snatching victory from the jaws of defeat. Be under no illusions, being a hunter requires patience and discipline. You have to expect a share price to go against you in the near term and not panic when it does. You have to be prepared to make money from stocks that may never recapture the original price you paid for your first lot of shares. If you know your personality is one which demands instant gratification, this approach is not for you. I'm accustomed to hanging around with a stock when the price is going nowhere. Most of the money I make is in the third or fourth year that I've owned something. Said by Peter Link. Let's look at some examples of the hunters in action. Case study, Aker Solutions. Aker Solutions is a Norwegian oil services company headquartered in Oslo. It is a global provider of products and services related to the construction, maintenance and operation of oil and gas fields. One of my hunters bought this stock on April 14, 2008 at an initial price of €15.84 per share. Roll on a year and a half and the share price had plummeted. On September 28, 2009 my investor seized the opportunity to exploit Mr. Market and bought significantly more stock so as to reduce the average price paid for his overall position to just €7.61. On January 28, 2010 he sold his entire stake in the company with the shares trading at €9.58 after recognizing his original thesis was no longer valid. Had he not done anything he would have realized a loss of 40%. However, by having the courage of his convictions to buy significantly more shares when they were depressed, he sold out of the position having made a profit of 24%. The hunter turned a loser into a winner. Case study, Experian. Experian is an Irish company with operations all over the globe, including the USA. The company collects information on individuals and produces credit scores which are used by lenders to decide whether to extend credit to applicants or whether to give them a loan such as a mortgage. If you have ever been turned down for a loan following a credit check, chances are that the report the loan officer used to make his or her decision was generated by Experian. This paints a picture of a rather bulletproof business model because so many companies rely on Experian's reports in the day-to-day running of their businesses. What could possibly go wrong? A hunter bought the stock on June 13, 2006, at an initial price of £9.02 per share. Despite holding out through the credit crunch, this hunter subsequently sold his entire stake 5 years later on September 1, 2011. With the shares trading at £7.06 per share. Had he done nothing, his patience as a buy-and-hold investor would not have been rewarded and he would have realized a loss of 22%. So much for the saying, time is your friend when losing. Fortunately, the hunter had bought more shares in the company when they fell in price during that period. This reduced the average book price of his shares to £5.66 per share and meant that when he did sell he realized a profit of 19% and not a loss of 22%. Whilst 19% does not represent an earth-shattering investment, and you could argue that he should have sold and deployed his capital elsewhere, it is clear that the investor added significant value through his actions. he turned a loser into a winner. This is the type of investor I want on my team. Case study, Technip. Technip is a French project management, engineering, and construction firm for the oil and gas industry. It is seen as a world leader in what it does, whether subsea drilling, laying specially built pipelines, producing floating offshore platforms, or helping to plan the development of an oil or gas field. One hunter bought this stock on April 11, 2008 at an initial price of €55.42 per share, and sold it just over 2 years later on May 21, 2010. When the shares were trading at €52.13 per share. On the face of it, this was a poor investment that lost 6% and tied up capital that could have been better deployed elsewhere. However, this hunter stuck to his process of buying materially more shares in the company if the share price falls and nothing otherwise has changed. He bought heavily during the 2-year period when the shares sold off. By doing this, he managed to reduce his average book price per share to €42.24. This meant that instead of realizing a small loss, he actually realized a gain of 22%. Case study, Thomson Reuters. Thomson Reuters is a multinational media company based in New York. It is one of a number of leaders at providing the very latest content and data to the finance industry. It produces material to help lawyers and accountants ensure they are meeting their requirements of continued professional education. It also produces research for the pharmaceutical industry. On the face of it, this looks like a solid business with attractive end clients. Surely nothing could go wrong? A hunter bought the stock on June 13, 2006 when the shares were trading at £22.25 each. 3 years later, he decided to sell his entire stake in the company, with the shares trading at £18.92 per share on September 10, 2009. Thankfully, because he had bought materially more shares in the first few years of his holding when the share price had fallen, he was able to reduce his average book price to £15.82 per share. This meant that instead of realizing a loss of 15%, he made a profit of 17%. Hunting for the compounding effect. Apart from discovering that E equals mc squared, Einstein was also famous for saying, "Compound interest is the most powerful force in the universe." John Larry Kelly Jr., a famed mathematician, showed that the way to create wealth was to invest in a manner that attempted to maximize the geometric mean of returns. By doing this, you would exploit the power of compounding and become rich in the shortest possible time. I do not intend to go into the detail of the Kelly criterion as it is now famously called, but suffice to say this formula shows that you should invest big when the odds are great and you have an edge. Warren Buffett is the most famous exponent of this approach. He invested 42% of Berkshire Hathaway in American Express in 1974 because he thought the odds were outrageously in his favor and he had an edge in his assessment of how that business would perform in the decades ahead. One of the reasons that being a hunter works so well is that it provides you with such opportunities. If a stock you are invested in has fallen materially in price, but nothing else has changed, the investment thesis is still intact, your odds will have improved significantly and you should materially increase your stake in that company. One of the hunters invested 20% of the assets he managed on my behalf in Barclays shares when they traded at just 55p in 2009, having been battered during the global financial crisis in 2008. The shares rebounded and he made a lot of money. The key point here is that although the hunter invested big in Barclays at the outset, he was prepared to invest a lot more money should it continue to fall, because the odds would have gone from great to extraordinary. If you believe the way to control risk is to have a diversified portfolio, then obviously you have no choice but to invest small stakes in each company. If you are a hunter, though, you choose not to control risk by diversification but by thoroughly understanding the risk and returns of a particular stock or handful of stocks. Your goal is to find companies that have an unbelievably attractive, asymmetric payoff profile. The fact that you are only investing in a few companies means that you have the opportunity to invest big on day one and then follow up with large top-up investments should the share price fall. As Warren Buffett said in his annual letter to the shareholders of Berkshire Hathaway in 1993, if you are a know-something investor, able to understand business economics and to find 5 to 10 sensibly priced companies that possess important long-term competitive advantages, conventional diversification makes no sense for you. It is apt simply to hurt your results and increase your risk. I cannot understand why an investor of that sort elects to put money into a business that is his 20th favorite rather than simply adding that money to his top choices, the businesses he understands best and that present the least risk, along with the greatest profit potential. In the words of the prophet Mae West, too much of a good thing can be wonderful. The hunters often put 20% of their assets in a single stock and had to be comfortable investing another 20% in that same stock when it was heading south. Most of us would suffer sleepless nights knowing that we had invested 40% of our money in a single stock. One way of dealing with this is obvious. Choose to only review the position every 5 years or set up an alert on your trading account to inform you if the price drops by a certain threshold. It never ceases to amaze me how being ignorant of share price swings helps a person stay invested in a large position. I would also advocate setting up standing orders in the market when you buy your first stake in a company. It is very easy to freeze with fear when shares drop, even if it's to a price that we said at the outset we would be happy to buy more shares at. Monish Prabhai talks about having a crystal clear exit plan before you ever think about buying a stock. 29 I agree, but also advocate having a clear plan for topping up losers as well. The advantages of a hunter. In the tables below I show the hypothetical investment activities of a hunter, an assassin and a rabbit, so that you can appreciate the power of the hunter's approach. All start out with $900 to invest. The hunter adopts the 3 bites at the cherry approach to investing, which means that he initially invests a third of the total amount he is willing to invest in the stock. If the price falls beyond a certain threshold, he invests another third. If the price falls yet further, he will deploy his final third of remaining capital in the stock. The rabbit invests his entire stake, $900, in one go and adopts a buy and hold approach. The assassin also invests his entire stake of $900 in one go, but will only keep holding it if it doesn't hit the stop loss set at 25% below his original purchase price. As can be seen, after 4 years of investing in a disciplined pound cost averaging fashion, the hunter has made $270 profit, 30 being willing to stick with the losing position and by significantly more shares paid off. The rabbit, on the other hand, who, like the hunter, also stayed invested throughout, is showing a loss of $90 because he went all in on day one and subsequently did nothing. By going all in, the rabbit lost the optionality to buy more shares when they fell in price. His fate was tied to that one point and one price. On the face of it, the assassin did the worst. He lost $225 and sold out. However, whether he was the worst investor depends on the returns he experienced from deploying the remaining $675 in other investments over the next 2 years. 3 choices, but only 2 make sense. As you can see, if you find yourself invested in a stock that is losing money, you have to decide whether to be an assassin, cut and invest the proceeds elsewhere, or a hunter, invest more money in that stock. I do not propose to tell you which approach to adopt. You will know yourself which approach best suits you. A rare investing style. My experience of managing an elite group of professional investors is that when the shares of a high conviction company fell in price, most invariably stayed optimistic, rightly or wrongly. Most gave me chapter and verse as to why the story and the fundamentals had not changed, and why it still remained a great investment idea. But most did not buy materially more shares. This was madness. If they were telling me it is still a wonderful company, and the millions of pounds they had lost would be recovered, why would they not buy materially more shares when this amazing company's shares were now trading significantly below the price at which they first bought them? One powerful technique I found useful in persuading some of the investors to add to a losing position was to get them to look beyond their current position and at their broader portfolio. If the overall portfolio was making money, I could say to them, look, you are in profit and can afford to add to the losing position, why not put some of that profit to work? Or, if they were sitting on cash, I would point out that the return expectations of the battered stock had to be better than the return offered by cash, especially in a zero interest rate world. I am sure the professional investors who worked for me were not unique in their reluctance to adopt the approach of the hunters. The reasons underlying their reticence to deploy more capital in a losing stock were varied. 1. Outflows. Most funds are priced daily and clients can invest or disinvest in a fund on a daily basis. If you are managing a fund suffering from redemptions, not only are you unable to buy a stock that has been beaten down, you might actually have to sell to meet the redemptions, further compounding the problem. 2. Not enough cash or no inflows. I experienced this problem with one of the managers I used to manage. He did nothing when his shares got beaten up unless he was fortunate enough to get an inflow of cash at that time. He did not keep any cash on the side to give him the option to top up a loser, nor did he take some profits from other positions to top up the losing ones. Most fund managers I have met seem to have an aversion to selling down or selling out of another stock to invest more money in a losing one. Deep down, they likely fear they will compound their initial mistake. 3. Peer pressure. The pressure felt by professional money managers when things are not working in the short term can be intense. Often it will lead them to make the wrong decision. They do nothing because they rationalize that they are damned if they do and damned if they don't. The effects of peer pressure in the investment industry were strikingly exemplified in an article about a court case brought by a fund manager, Patrick Evershed, against his former employer, the ill-fated asset management firm New Star. Evershed's account of life at New Star has revealed a culture of fear, with allegations that bullying and the humiliation of staff was commonplace. It includes John Duffield, New Star's founder, withdrawing an offer of sweets from managers having a bad period of performance, as well as accounts of him pacing around the office calling managers' names. Evershed said he believed the much publicized demise of New Star was as a direct result of Duffield's bullying, his interference with the way in which the fund managers managed their funds, and his refusal to take on board anyone's advice. He, Duffield, would prowl around the floor on a regular basis with his jaw jutting out and emitting growling sounds and call us morons and criminals. He knew how every fund was performing each hour, and he would compare our performance against each other in such a way as to cause distress to those who had had a bad hour or day, Evershed claimed. New Star's formal response to his grievances, made via letter in 2009, saw Duffield admit to offering sweets to managers but deny ever withdrawing them based on fund performance. Evershed described the atmosphere at work as horrendous and extremely unpleasant, stating it was so intimidating, so humiliating, so distressing. As Michael Lewis put it in Moneyball, most failing strategies fail because they all have one thing in common: they are designed with fear of public humiliation in mind. Every change he made was aimed more at preventing embarrassment than at achieving success. To reduce his strikeouts, he shortened his swing and traded the possibility of hitting a home run for a greater likelihood of simply putting the ball in play. Managers tend to pick a strategy that is least likely to fail. The pain of looking bad is worse than the gain of making the best move. No one is immune to this. Research in the 1950s by American psychologist Solomon Asch showed just how susceptible we all are. If several people around you are shown the color red and are then asked what color they see, if they all say green, then most likely you will also say green. No one is ever trading in isolation, whether in the city or on Wall Street, or at home in our pajamas. We are part of a larger community that tends to move as a herd. Peer pressure has the ability to prevent us taking the right decision to either buy more shares or sell out. For a prior price movement, the price movement of the stock prior to your purchase matters because of representative bias, a term again first coined by Tversky and Kahneman. 32. Quite simply, a stock price that has gone up is seen as good and will attract buyers, while a stock price that has gone down is seen as a dog and will be shunned by all but the bravest investors. As such, most will choose to stand on the side and wait for the stock they hold, and which has lost them money, to recover rather than getting involved while the price is still falling. This is known as the bystander effect. 33. Adding to a loser is seen as a bad idea, but so, perversely, is selling a loser. Remember, losers hang around with losers and do nothing to get themselves out of their position. Conclusion to Part 1. In the first part of this book, I have attempted to show that success often arises from what you do when you are losing. My findings reveal that you can get big decisions wrong and still make money provided you are willing to materially adapt. Below I have put together a decision matrix showing the consequences of the rabbits, assassins, and hunters' decisions. This matrix clearly shows that doing nothing is never an option. In my management of investment talent, I focus relentlessly on what my investors do when they are losing. You cannot change the past, but you can change the future. Many professional investors neglect to focus on the execution of the idea. Proof of this can be seen in the way a typical investment house is set up. They will typically have hundreds of highly educated analysts whose job it is to come up with stock ideas, from which a fund manager cherry picks the best ones for his or her portfolio. Furthermore, when the fund manager puts together this portfolio of stocks, he or she is focused on how these stocks correlate with one another to manage risk as opposed to how he or she will execute each of the ideas. A more forward-thinking approach would see resources just as much, if not more, focused on helping the fund manager execute the investments. Well, I find it bizarre that top athletes and sportsmen and women have coaches, but the majority of investment professionals do not. How can they expect to improve their game if they do not have constructive feedback? End of the Part 1. Chapter 3, The Hunters Pursuing Losing Shares. After this we'll start Part 2.